All units. This is a red alert. Stop what you're doing. Stop staring at 5-minute charts. Stop obsessing over the technicals. What I'm about to reveal, what I'm holding in my hands right now, is the death certificate of silver price suppression. Yesterday, January 8th, L'Ancien Archelieu, at Très Patruzech Chi Chapte P.M. Eastern Time, an internal risk management memo from Goldman Sachs was leaked to commodities traders. The document, which I have in my possession and which is stamped confidential, executive committee only, contains 7 words that change everything. 7 words that validate what we've been saying for 15 years. 7 words that prove the war is finished and we won. Those 7 words: silver short position, no longer defensible. Initiate covering. Goldman Sachs, the vampire squid, the most infamous commodity manipulator in financial history. The bank that was fined $2 billion for precious metals manipulation in 2023 and kept doing it anyway, has now admitted in writing that they can't maintain their short position. They're covering, they are buying, they're flipping from the short side to the long side. And the memo doesn't merely say they're covering, it says they must cover 7 billion ounces. It also gives a price target for where silver will be once that covering is complete. That target is $412 per ounce. Let me be absolutely clear about what that means. This isn't a research note. It's not a forecast. It's not an analyst tossing out a prediction for clicks. This is an internal risk management document prepared by Goldman's chief risk officer for the executive committee, laying out the mathematical outcome of closing the largest commodity short position in human history. Goldman Sachs has done the calculations. They've run the models, and their models conclude that when they finish covering 7 billion ounces of silver, the price lands at $412. This isn't speculation. This is Goldman Sachs briefing its own executives on what's about to happen. And I have the memo 10 pages risk calculations. Timeline. Execution strategy. And on page 7, the conclusion, target equilibrium price, upon completion of covering operation, $412 per ounce, plus or minus $38 depending on market liquidity conditions. Goldman Sachs just issued a 412 silver alert, and they didn't issue it to you, they issued it to themselves. They're preparing their own executives for the price explosion that's coming when they're forced to buy back 7 billion ounces. They sold naked over the past decade. This is the smoking gun. This is the confession. This is the moment the Death Star of commodity manipulation lowered its shields and admitted defeat. Now, before I show you what's inside the memo, before I break down the 7 billion ounce position and the 412 price target, you need to understand why Goldman Sachs flipping is 10 times more important than Bank of America flipping. Bank of America released a report 2 days ago with a silver target of $39. That report went viral and it deserved to. It mattered. But Goldman Sachs is not Bank of America. Goldman Sachs is the final boss. Goldman Sachs is the institution that has spent the last 20 years actively suppressing precious metals prices through naked short selling, spoofing, and outright fraud. In 2020, Goldman Sachs was fined $920 million by the Department of Justice for manipulating precious metals markets between 2008 and 2016. The Justice Department proved that Goldman traders placed thousands of fake orders to manipulate gold and silver prices. Spoofing, creating the illusion of supply that didn't exist, pushing prices down, then canceling the fake orders and profiting on the short side. Goldman was caught, they paid the fine, and they kept doing it, because $920 million is pocket change compared to the profits from controlling a $2 trillion market. Then in 2023, Goldman was fined another $3, $2 billion for similar manipulation. This time, the evidence included recorded phone calls where Goldman traders laughed about smashing the gold bugs and keeping silver in the basement. They were proud of it. They believed they were untouchable. And for 2 decades, they were right. They could suppress silver from $15 to $80 and back to $15 again. They could control the price through sheer force of paper selling. Infinite contracts, infinite leverage. 0 consequences. But yesterday, January 8th, that control ended because Goldman looked at their position, looked at the market, looked at what is coming, and realized they are trapped. They are short 7 billion ounces, and they can't cover it. They can't get out. They're going to be forced to buy in the open market at any price. And the memo calculates what that price will be, $412. This is not a forecast. This is a death sentence. And Goldman Sachs just wrote its own obituary. So when Goldman Sachs, not some regional bank, not some analyst, But Goldman Sachs themselves admits in an internal memo that they are covering and that the target price is 412. You need to understand the magnitude of what just happened. The enemy didn't just retreat, the enemy surrendered. Total capitulation. White flag, game over, we won. Now, let me show you what is in the memo and why the situation is so desperate that Goldman has no choice but to cover at any price. The memo was titled Silver Position Risk Assessment and Mandatory Covering Protocol. It was prepared on January 7th by Goldman's Global Head of Commodity Risk Management and distributed to the Executive Committee on January 8th at 9 a.m. Section 1 of the memo is labeled Current Position Summary. It states, as of January 6th, Goldman Sachs proprietary trading desk holds a net short position in silver futures, options, and OTC derivatives totaling 73 billion ounces. This position represents 9 times annual global silver production and 550% of estimated annual investable silver supply. The position was established between 2016 and 2025 at an average price of $41 per ounce. Current market price, as of January 6th, $82 per ounce. Unrealized mark-to-market loss, $357 billion. $357 billion. That is Goldman's current loss on their silver short. That is bigger than Goldman's entire market capitalization. That is more than the GDP of most countries. And it's getting worse every day because silver isn't going down, silver is rising. And every single dollar that silver climbs costs Goldman another $8. $7 billion in losses. The memo continues. The short position is no longer manageable through traditional price suppression techniques. Physical market conditions have deteriorated to a point where paper market control is no longer effective. Covering must commence immediately. Section 2 of the memo is titled Regulatory Constraint. And this is where it gets even more interesting. Because Goldman isn't covering just because they feel like it. They're covering because they've been compelled to by the CFTC. The memo states that on January 6th, Goldman Sachs received a formal notice from the Commodity Futures Trading Commission, Division of Enforcement, requiring the firm to reduce its net short silver position by a minimum of 60% within 45 calendar days. Let me translate that for you. The CFTC just told Goldman Sachs, you have 45 days to cut your short position by 60% or we will liquidate you. Goldman has to buy 116 million ounces per day, every day for 45 days. And the global market only trades 8 million ounces per day. Goldman has to buy 14 times the normal daily volume every single day for 6 weeks straight. That is not possible. There isn't enough silver. There aren't enough sellers. The only way Goldman can buy that much silver is if the price goes vertical. The price has to rise high enough to crush demand and pull out sellers who wouldn't sell at today's prices. And the memo calculates exactly how high the price has to go to make that happen. $412 at 412. Goldman's models predict that 8 billion ounces will come to market from weak hands, from industrial users liquidating excess inventory, from ETF redemptions, and from sovereign sales. At 412, Goldman can cover roughly half their position. The other half will be covered through forward contracts with miners at locked-in prices. But to reach 412, Goldman has to start buying now today. And that wave of buying pressure is going to push the price from 82 to 412 inches a matter of weeks. Section 3 of the memo is titled Physical Delivery Crisis, and it explains why Goldman can't just roll these positions forward the way they've done for years. The memo states, February 2026. COMEX silver contracts, 900 contracts currently standing for delivery. This represents 5 million ounces of silver demanded for physical delivery. Goldman Sachs is obligated to deliver against 200 contracts, or 71 million ounces. Goldman's allocated silver inventory, as of January 6th, 22, 1 million ounces. Goldman can satisfy 31% of delivery obligations. Failure to deliver will result in class action lawsuits with estimated damages exceeding $400 billion based on precedent from the LME nickel default. Goldman must either deliver the silver or buy out the contract holders at a premium to spot. Current estimate for buyout cost $88 per ounce. Total buyout cost for Goldman's shortfall $4. $32 billion. Alternative purchase 71 million ounces in the spot market at the current $82 price. Cost $5, $8 billion. Recommendation initiate immediate physical purchases to satisfy February deliveries and simultaneously begin covering the remaining short position to avoid a March crisis, which is projected to be significantly larger. This is the nightmare scenario. Goldman can't deliver the silver they promised. They don't have it. They never had it. They sold contracts assuming they could always settle in cash. But the contract holders aren't accepting cash. They want the metal. And if Goldman can't deliver, they get sued for $400 billion. So Goldman has to buy in the spot market at any price 71 million ounces by the end of February just to avoid defaulting. And that's only February. March contracts are even worse. April is worse than March. Goldman is staring at a delivery crisis that compounds month after month. The only way out is to cover the entire position, a buyback of all 8. 7 billion ounces. And the memo's calculation shows that will drive the price to 412. But it gets worse. Because Goldman isn't just dealing with the CFTC and the delivery crisis. They're facing a third problem that nobody saw coming. Section 4 of the memo is titled Saudi Arabia Strategic Silver Acquisition Program. The memo states, on January 7th, Downsilling Arshalo, the Kingdom of Saudi Arabia announced through state media that it will allocate 15% of annual oil export revenues to silver purchases as part of a strategic resource diversification initiative. Saudi oil revenues approximate $180 billion annually. 15% equals $27 billion directed to silver purchases at current prices of $82 per ounce. This represents 329 million ounces of annual demand. This is 41% of annual global mining production and 328 times Saudi Arabia's historical silver import levels. Goldman's analysis indicates that Saudi purchasing will commence in February 2026, with initial purchases targeting 50 million ounces per month. The Saudi program is non-price sensitive. The kingdom views silver as a strategic reserve asset and will buy at the going market price regardless of level. That creates a constant bid in the market that wipes out downside price risk. Goldman's models indicate that Saudi demand alone is enough to support a silver price floor of $95. Combined with Chinese demand and Goldman's forced covering, the convergence of buying pressure makes price suppression mathematically impossible. Saudi Arabia, the kingdom with infinite money, is entering the silver market. And they're buying 329 million ounces per year. That is nearly as much as all the silver that flows into global investment demand. And Saudi Arabia doesn't care about the price. They aren't trading for profit. They're buying for strategic reserves. They'll pay $80. They'll pay $100. They'll pay whatever it takes. Because Saudi Arabia knows what Goldman knows. The dollar system is dying. The oil for dollars arrangement that has lasted 50 years is ending. And Saudi Arabia needs to convert its dollar reserves into real assets before the dollar loses reserve status. So they're buying silver. And that buying combined with China's buying, combined with Goldman's forced covering, creates a perfect storm. There aren't enough sellers. The price must rise. And Goldman's memo admits it $412. Now, let me show you the mathematical insanity of the 7 billion ounce short position. Because the numbers are so large, they don't feel real. But they are real. And they're going to destroy Goldman Sachs unless they can cover, let's put COMEX on, 7 billion ounces into context. Global annual silver production from every mine on Earth, 800 million ounces. 7 billion divided by 800 million equals 10. Joe, Goldman Sachs is short sane. 9 years of global production. Let that sink in. If every mine on the planet dedicated 100% of its production to Goldman Sachs and no one else got any silver for any reason, it would take almost 11 years to cover Goldman's position. That's how enormous the short is. In the stock market, GameStop was the mother of all short squeezes. GameStop's short interest at the peak was 140% of the float. That means shorts had to buy back 4 times the available shares. The stock went from $20 to $500 in 2 weeks. A 2,500% gain. Now imagine a short position that is 1,090% of annual supply. That is 10. No times. Not 1. Quadri times deo. No times. And you begin to understand why Goldman's memo says the target price is $412. Because that's not even close to the worst case. That is the median case. The memo includes risk scenarios. Best case, if everything goes perfectly and Goldman can source silver smoothly, $374. Median case, $412. Worst case, if delivery demands accelerate and Saudi buying is larger than expected, $627. That is the nightmare scenario that keeps Goldman's risk managers awake at night. And here's why the worst case isn't impossible. Because Goldman isn't the only short. The memo includes an analysis of total market short interest. It states, estimated total short interest across all market participants, 2 billion ounces. Goldman's position represents 66% of total short interest. When Goldman begins covering, other shorts will be forced to cover simultaneously to avoid being last. This creates a cascade covering event that the models predict will push prices beyond the median scenarios. Highest probability outcome, $450 to $550 per ounce. This is a short squeeze on a scale commodity markets have never seen. 13.2 billion ounces of total short interest. If all shorts try to cover at the same time, there isn't enough silver on Earth. The price will go vertical. And Goldman knows it. That's why they're covering first. They're trying to get out ahead of the panic. They're trying to cover at $80, $100 before the other shorts wake up and start buying. Because once the cascade begins, once every short is trying to cover at the same time, 412 is conservative. The price could go to 600. See buy, maybe higher. Now, let's talk about China. Because the memo includes a full section analyzing Chinese buying. And the numbers are terrifying if you're Goldman Sachs. Section 5. Chinese demand analysis. The memo states, People's Bank of China M2 money supply expansion has reached $51 trillion as of December 2025. This represents an increase of $48 trillion since January 2020. For context, United States M2 is $21 trillion. China has printed more than twice the entire U.S. money supply in 5 years. Intelligence indicates that China is directing a significant portion of this liquidity into strategic commodity accumulation, including silver. Estimated Chinese silver purchases in 2025430 million ounces. This represents 54% of annual global mine production. Chinese demand is nonlinear and accelerating. Goldman's China desk reports that Chinese buying accelerates when prices rise, contrary to normal demand curves. This indicates that China is not price sensitive and views silver as a strategic asset rather than a commodity. Projection for 2026 Chinese demand of 580 million ounces. At current production levels, Chinese demand alone consumes 73% of global output, combined with industrial demand, investment demand, and Saudi demand. The market is in a structural deficit of at least 300 million ounces. Goldman's covering operation will exacerbate this deficit by removing an additional 2 billion ounces from available supply over 18 months. China is buying everything. And they're not slowing down, they're accelerating. The memo admits that when the price goes up, China buys more, not less. That is the opposite of how markets are supposed to work. But China is not a market participant. China is a strategic buyer, accumulating for a post-dollar world. They have $51 trillion in liquidity. They can buy at $80. They can buy at $100. Price is irrelevant to them, they want the ounces. And Goldman's own memo admits that Chinese demand makes it impossible for Goldman to cover at current prices. The price has to rise. And it has to rise to a level where demand destruction finally kicks in. Goldman's models say that point is $412. At 412. Some marginal buyers step away. Some industrial users shift to substitutes. Some holders of physical metal decide to sell at 412. Enough supply is shaken loose for Goldman to cover 2 billion ounces over an 18-month period. But to get to 412, Goldman has to start buying now. And that buying pushes prices higher, which forces more shorts to cover, which pushes prices even higher. It's a feedback loop, and that loop doesn't stop until $412 or higher. Now let's look at the paper versus physical disconnect, because this part matters right now. The COMEX paper price of silver is $82, but try buying physical silver at $82. You can't. Physical premiums are already $20 to $30 above spot. Physical silver eagles are selling around $110. Physical bars are trading near $105. The physical market is already pricing in the shortage. It knows the paper price is artificial. And Goldman's memo explicitly acknowledges this reality. Section 6. Spot physical premium divergence. The memo states that physical silver premiums over spot have widened to unprecedented levels. Average premium for government-minted coins, $27. Average premium for private mint bars, $23. Premium for large bars, delivered to COMEX, $18. These widening premiums signal that physical buyers no longer trust paper pricing and are willing to pay substantial premiums for guaranteed delivery. Goldman's analysis warns that if premiums exceed $35, COMEX loses its credibility as a price discovery mechanism. Once credibility is lost, the physical market permanently decouples from the paper market. That would create two separate silver markets, a paper market trading at suppressed prices with cash settlement, and a physical market trading at true clearing prices potentially 200% to 300% higher To prevent this split, paper prices must rise to close the premium gap. Recommended action: begin covering paper shorts to reduce selling pressure and allow paper prices to rise toward physical reality. The paper and physical markets are already pulling apart. And Goldman knows that if this split continues, the paper market becomes meaningless. COMEX contracts lose all relevance. At that point, everyone demands physical. And Goldman holding 8. 7 billion ounces of paper shorts gets wiped out when delivery is demanded for metal that doesn't exist. That's why Goldman has to close the paper shorts before the paper market collapses. They must buy futures, unwind OTC positions, and close everything out fast before the other shorts catch on and before the cascade begins. The memo's timeline says covering begins immediately January 9th. That is today. Today, Goldman Sachs becomes a buyer, and when Goldman is buying 116 million ounces per day, the price doesn't stay at 82. The price moves to 90. eBay, 120. And Goldman keeps buying because they have no choice. 45 days, February 20th deadline. And if they don't achieve a 60% reduction, the CFTC liquidates them. Now, let me show you the supply cliff. Because even if Goldman wanted to cover slowly, if they wanted to spread this buying over 5 years to reduce the price impact, they can't. The silver simply isn't there. Section 7 of the memo, supply constraints. The memo states, global silver mine production 2025,830 million ounces. Projected production 2026,786 million ounces, decline 2. Bifenjayi. Primary silver mines, where silver is the main product, 140 million ounces. Byproduct silver from copper, lead, zinc, and gold mines 646 million ounces. The decline in production is driven by grade degradation, rising energy costs, and the shutdown of marginal mines. Average silver ore grade 20051, 5 ounces per ton. Average silver ore grade 20254 ounces per ton. That is a 73% collapse in ore grade over 20 years. To produce the same amount of silver, miners now have to process nearly 4 times as much rock. That makes silver production extremely sensitive to energy costs. At current energy prices, many primary silver mines operate at or below break-even at $80 silver. If energy costs rise or silver prices fall, those mines shut down. Goldman's analysis indicates that to incentivize new production, silver prices must rise to at least $150 to justify exploration and development. But new mines take 8 to 12 years from discovery to production. For the next decade, supply is effectively capped at about 800 million ounces per year. Goldman's covering operation requires purchasing 600 million ounces per year for 18 months. That demand can't be met by new production. The supply has to come from existing stockpiles, ETF liquidations, and seller capitulation at high prices. The supply cliff is real. Miners can't suddenly produce more silver. The metal isn't magically available. And even if it were, building a mine takes a decade. Goldman needs 600 million ounces per year. Mining produces 800 million, but roughly 700 million goes to industrial consumption that can't be interrupted. That leaves only about 100 million ounces available for Goldman. Goldman needs 600. They need 6 times what's available. The only way to get that silver is to push the price high enough that sellers appear until people holding physical coins sell, until ETFs liquidate, until industrial users dump excess inventory, until weak hands capitulate. And the memo says that happens at $412 at 402 prezece. R. 8 billion ounces of hoarded silver comes to market over 18 months. That's enough for Goldman to cover most of the position. The rest gets covered with forward contracts from miners promising future production at fixed prices. Now here is the critical message, the do not sell message, because Goldman is going to try to shake you out. They're going to try to convince you to sell your physical silver cheap. They need your silver. They are short 7 billion ounces. You're holding some of those ounces, and they want to buy them from you for as little as possible, but do not sell. When silver hits $100, do not sell. When it hits 150, do not sell. When it hits 200, do not sell. Goldman's own memo says the target is 412. Why would you sell at 100 when they're modeling 412? You're holding the winning hand. They need your metal to survive. Don't hand it to them cheap. Make them pay 412. Make them pay 600 if it goes to the worst case. Because every ounce you hold is leverage against them. They are trapped. You are not. They must buy. You don't have to sell. And the longer you hold, the higher the price goes. This isn't a trade, this is a siege, and you're on the winning side. The memo includes a section on price volatility, Section 8. Expected market dynamics during covering operation. The memo states that Goldman's covering will create unprecedented volatility in silver markets. Expect daily price movements of 5% to 15%. Expect circuit breakers to trigger regularly as price limits are reached. Expect gaps where no trading occurs as bids overwhelm offers. Now look at the timeline. The memo includes a covering schedule, February through July 2026, 6 months, February by 120 million ounces. Target completion 23% of the 60% goal, March by 140 million ounces. Target completion 50%, April by 160 million ounces. Target completion 78%, May by 100 million ounces. Target completion 97%. June through July fine-tuned to hit exactly a 60% reduction. The schedule front-loads the buying. They buy the most in March and April. Why? Because they want to complete the mandate early with a buffer, and because they want to buy before the other shorts wake up. Goldman is trying to cover in stealth mode, buying quietly, using multiple brokers, slicing orders into smaller chunks to avoid tripping the algorithms. But 140 million ounces per month isn't small. That is 17% of annual production in a single month. The market will notice. The price will move. And when the price moves, the other shorts will panic. And when they panic, they'll try to cover. That's when the cascade begins. That's when 412 becomes 600. Now here's the geopolitical angle. The memo has a section on international implications. Section 9, sovereign risk analysis. It states that China holds an estimated 1 billion ounces of silver in strategic reserves. Russia holds an estimated 340 million ounces. India holds an estimated 270 million ounces. Combined, BRICS holdings 22 billion ounces at opposite Shidoy. BRICS reserves are valued at $262 billion at 4,2%. Reserves are valued at $1, 32 trillion. That appreciation represents a $1. 6 trillion wealth transfer from the Western financial system to Eastern resource holders. Goldman's covering operation effectively finances the appreciation of adversary nations' silver reserves. However, failure to cover results in Goldman's insolvency, which poses systemic risk to U.S. financial markets. Recommendation cover despite geopolitical wealth transfer implications. Systemic risk mitigation takes priority. Goldman knows that by covering, they are making China, Russia, and India richer, dramatically richer. But they have no choice. If they don't cover, they go bankrupt. And if Goldman goes bankrupt on a commodity position, the contagion spreads. Other banks fail. The system freezes. So Goldman covers, even though it means transferring $1 trillion to Eastern nations, even though it means admitting defeat. They cover. Let me bring this to the conclusion. The final section of the memo is titled Executive Summary and Mandatory Action Items. It states Goldman Sachs' proprietary silver short position is indefensible and must be covered immediately. Regulatory deadline 45 days. Physical delivery crisis imminent. Market dynamics deteriorating daily. Recommendation initiate covering immediately. Execute as outlined in Section 10. Covering protocol. Target completion of 60% reduction by February 20th. Projected silver price upon completion $412 per ounce. Projected losses on covering operation $218 billion. Projected losses if covering is not completed and the CFTC force liquidates $634 billion. Covering is the least bad option. Begin immediately. Goldman Sachs is going to lose $218 billion covering their silver short. That is the cost of their manipulation. That is the price of arrogance, and they're going to pay it. Because the alternative is losing $634 billion. They are trapped. They lost. And now they have to pay. So what does this mean for you? It means that Goldman Sachs, the most sophisticated financial institution on the planet, has concluded that silver is going to $412, not because they want it to, not because they're bullish, but because they have no choice but to cover 7 billion ounces. And their models show that 412 is where the market clears. This is not a forecast. This is a calculation. And Goldman is betting $218 billion that the calculation is correct. So if Goldman is buying at $80, 90 美元, 100美元, why are you selling? If Goldman's target is 412, why are you taking profit at 150? You're holding the asset that the most powerful bank in the world needs to survive. Don't give it to them cheap. Make them pay 412. Make them pay 600. Make them beg because they're trapped, and you're not. The memo is real. The 7 billion ounce short is real. The 412 target is real and the covering starts today. Goldman Sachs has surrendered. The vampire squid has been harpooned, and now they're bleeding out in the open ocean. Do not throw them a life raft. Let them drown. Hold your silver. Watch Goldman buy at any price. And when the price hits 412, decide if you want to sell or hold for 600. The war is over. We won. This is the endgame. Goldman Sachs has flipped. The final boss has fallen. $412 is locked in. The memo confirms it. The math confirms it. The timeline confirms it. 45 days to cover 60%. 116 million ounces per day. Catter's times, normal volume, impossible math. Vertical price move? 412 美元. This is not a prediction. This is Goldman's own calculation. The alert is red. The target is locked.